Welcome to Windfall Edutech Beginners Module. Chapter 4, Investing in Equity Market. Technical requirement. Begin investing. Where, how, process. Types of share trading. Fundamental trading. Scalping. Technical trading. Day trading. Momentum trading. Swing trading. Position trading. Concept of margin trading. Buying on margin. Selling on margin. Types of orders. Limit order. Market order. Stop-loss order. Circuit filters and trading bands. Badla financing. Insider trading. Begin trading. The recipe. Trading recipe. Take the obvious, add a cupful of brains, a generous pinch of imagination, a bucketful of courage and daring, stir well and bring to a boil. Technical requirement. Procedure to open a Demat account. To start with, you need to have a Demat account set up as simple as opening a bank account. You need a PAN card, photo proof and residence proof. Fill up an account opening form available with an authorized broker. Sign the agreement defining rights and duties between you and the broker. You will receive a client ID and a Demat account number unique to you. You will receive shares only in Demat form without any instruction to your broker as per SEBI guidelines. Fill up a dematerialization request form, available with your DP. Submit your share certificates along with the form, right, surrendered for Demat, on the face of the certificate before submitting it for Demat. Receive credit for the dematerialized shares into your account within 15 days. Begin investing. Where? To invest in stock market, you have two options, i.e. to invest directly or through a mutual fund. Direct investment. The first step for the investor is to open a Demat account with the broker. You already know. Through mutual fund, you need to fill the mutual fund application form and submit to the AMC Asset Management Company. Begin investing. How? Open a Demat account with a broker or sub-broker who is registered with SEBI. Brokerage charges are charged by the broker or sub-broker. Ensure you negotiate well to get the lowest transaction fee. Once you open an Demat account, you can regularly monitor and make changes in your portfolio of stocks in consultation with your broker. Begin investing. Process. First, place order with your broker. Broker routes the order through his system to the exchange. The order stays in the Q exchange's systems and gets executed. Order must be within specified buy limit. Broker buys the share and sends it to you in the physical or Demat format. Types of share trading. Share market is the place where people dare to dream and where dreamers are dealt a healthy dose of reality. Of course, the smartest ones learn how to deal with that reality to make their dreams come true. For example, companies that are growing quickly often trade at a higher price than the company might currently be worth. Stock prices are also affected by all forms of company and market news. Stock price is of utmost importance while trading. Fundamental trading, scalping, technical trading, day trading, momentum trading, fundamental trading. This investment style looks at the health of a company's bottom line before taking a position. If the company appears strong, fundamentalists will take a position with the intention of owning it until the health of the company changes. This can range anywhere from a few months to a few years. Scalping. A scalper is like a day trader on speed. Utilizing cheap commission rates, a scalper can make dozens to hundreds of trades, trying to get a small profit from each trade. By taking advantage of the bid-ask spread, a scalper aims to make a few dollars. Technical trading. Technical trading involves buying, selling stocks based on signals from charts. Analysts or chartists predict where a stock is headed, upward or downward, based on charts and graphs calculated by volume and price movements of a stock. They issue buy and sell calls along with price targets and stop-loss figures. Technical trade calls may be valid for a day or also for long-term. Day trading. Day traders move in and out of positions based on news or technical triggers, however, do not hold positions overnight. Day traders often will trade multiple positions throughout the day. One of the riskier methods of trading. Many fortunes have been made and lost as would-be day traders chase the dream and end up losing their shirts. Momentum trading. Massive volume and wild price swings are the characteristics of momentum stocks. This type of trading takes advantage of abnormal behavior of stocks that have just released news that either has everyone pouring into the stock, or getting out of a stock quickly. Buy at the top or sell at the bottom, and you're left holding the bag well after the party is over. Get in at the right time, and you can make easy and fast money. Swing trading. This uses a slightly longer time horizon than day trading, watching a stock for weeks or months before trading. This type of stock market trading relies on careful monitoring of fundamental and technical analysis. Swing traders often specialize in a certain business or industry so that they become experts in the movement within those stocks. Position trading works well for investors who want to be involved in the stock market trading, but run short of time. Stocks are being held for months awaiting any changes in the trend. Position traders keep up with the fundamental and technical analysis as well as news events but apply a long-term strategy to their stock market trading. Concept of margin trading. To buy and sell shares, you need to have the required money. If you do not have the entire money, you can still trade with a percent of the value of the transaction called as margin money. In case the price during the course of the settlement cycle moves in your favor, risen in case of purchase done earlier and fallen in case of a sale done earlier, you will make a profit and you receive the payment from the exchange. In case the price movement is adverse, you will make a loss and you will have to make the payment to the exchange. Margins are thus collected to safeguard against any adverse price movement. Buying on margin. Suppose you have Rs 1 lakh with you in your bank account. You can use this amount to buy 10 shares of Infosys Limited at 10,000 rupees. In the normal course, you will pay for the shares on the settlement day to the exchange and receive 10 shares from the exchange which will get credited to your Demat account. Alternatively, you could use this money as margin and suppose the applicable margin rate is 25%. You can now buy up to 40 shares of Infosys Limited at rupees 10,000 value rupees 4 lakh, the margin for which at 25%, i.e. rupees 1 lakh. Now, as you do not have the money to take delivery of 40 shares of Infosys Limited, you have to cover square your purchase transaction by placing a sell order by end of the settlement cycle. Now suppose the price of Infosys Limited rises to 11,000 rupees before end of the settlement cycle. In this case your profit is rupees 40,000, which is much higher than on the 10 shares if you had bought with the intent to take delivery. The risk is that if the price falls during the settlement cycle, you will still be forced to cover square the transaction and the loss would be adjusted against your margin amount. Selling on margin. You do not have shares in your Demat account and you want to sell as you expect the prices of share to go down. You can sell the shares and give the margin to your broker at the applicable rate. As you do not have the shares to deliver, you will have to cover square your sell transaction by placing a buy order before the end of the settlement cycle. Just like buying on margin, in case the price moves in your favor, falls, you will make profit. In case price goes up, you will make loss and it will be adjusted against the margin amount. Types of orders. There are various types of orders, which can be placed on the exchanges. Limit order, market order, stop-loss order. Order refers to a buy or sell order with a limit price. Suppose, you check the quote of Reliance as 251 rupees, ask. You place a buy order for Reliance with a limit price of 250 rupees, putting a cap on your purchase price. In this case, as the current price is greater than your limit price, order will remain pending and will be executed as soon as the price falls to 250 rupees or below. In case the actual price of Reliance on the exchange was 248 rupees, your order will be executed at the best price offered on the exchange, say 249 rupees. Thus you may get an execution below your limit price but in no case will exceed the limit buy price. A market order is used by investors who expect the price of share to move sharply and are yet keen on buying and selling the share regardless of price. Suppose, the last quote of Reliance is 251 rupees and you place a market buy order. The execution will be at the best offer price on the exchange, which could be above 251 rupees or below 251 rupees. The risk is that the execution price could be substantially different from the last quote you saw. A stop-loss order allows the trading member to place an order which gets activated only when the last traded price (LTP) of the share is reached or crosses a threshold price called as the trigger price. The trigger price will be as on the price mark that you want it to be. Suppose you have a sold position in Reliance booked at 345 rupees. Later, in case the market goes against you, i.e., go up, you would not like to buy the scrip for more than 353 rupees. Then you would put a SL buy order with a limit price of 353 rupees. You may choose to give a trigger price of 351 rupees and 50 paise, in which case the order will get triggered into the market when the last traded price hits 351 rupees and 50 paise or above. Execution will then be immediate and will be at the best price between 351.50 and 353. However, stock movements can be so violent at times and prices can fluctuate from the current level to over and above the SL limit price you had quoted at one shot, i.e., the LTP can move from 350, 351, and directly to 353.50. At this moment your order will immediately be routed to the exchange because the LTP has crossed the trigger price specified by you. However, the trade will not be executed because of the LTP being over and above the SL limit price that you had specified, and you will not be able to square your position. As the market falls, i.e., if the script falls to 353 or below, your order will be booked on the SL limit price that you have specified, i.e., 353 rupees. Even if the script falls from 353.50 to 352, your buy order will be booked at 353 rupees only. Some seller, somewhere will book a profit, in this case form your buy order execution. An investor will have to understand that one of the foremost parameters in specifying on a stop loss and a trigger price will have to be its chances of execution ability as and when the situation arises. This vital parameter of volatility bands of scripts will always have to be kept in mind while using the stop loss concept. Circuit filters and trading bands. In order to check the volatility of shares, SEBI has come with a set of rules to determine the fixed price bands for different shares within which they can move in a day. All shares traded below 10 rupees per have a daily price band of 50%. All shares traded at or above 10 rupees per and below 20 rupees per have a daily price band of 25%. All shares traded at or above 20 rupees per has a daily price band of 8%. However, the price bands have been relaxed to plus or minus 8% for select 100 scripts after a cooling period of half an hour. The previous day's closing price is taken as the base price for calculating the price. As the closing price on BSE and NSE can be significantly different, this means that the circuit limit for a share on BSE and NSE can be different. Badla financing. In common parlance, the carry-forward system is known as Badla, which means something in return. Badla is the charge, which the investor pays for carrying forward his position. It is a hedge tool where an investor can take a position in a scrip without actually taking delivery of the stock. He can carry forward his position on the payment of small margin. In the case of short selling, the charge is termed as unda Badla. The CF system serves three needs of the stock market. Quasi-hedging. If an investor feels that the price of a particular share is expected to go up, down, without taking delivery of the stock, he can participate in the volatility of the share. Stock lending. If he wishes to short sell without owning the underlying security, the stock lender steps into the CF system and lends his stock for a charge. Financing mechanism. If he wishes to buy the share without paying the full consideration, the financier steps into the CF system and provides the finance to fund the purchase under the Viaj Badla or Badla financing scheme. For example, X has bought a stock and does not have the funds to take delivery. He can arrange a financier through the stock exchange Badla mechanism. The financier would make the payment at the prevailing market rate and would take delivery of the shares on X's behalf. You will only have to pay interest on the funds you have borrowed. Share lending. Shares lending program is from the NSE. It is similar to the Badla from the BSE, only difference being the CF system not being allowed by the NSE. This is wherein a holder of securities or their agent lends eligible securities to borrowers in return for a fee to cover short positions. Insider trading. Insider trading is illegal in India. When information, which is sensitive in the form of influencing the price of a scrip, is procured and used from sources other than the normal course of information output for unscrupulous inducement of volatility or personal profits, it is called as insider trading. Insider trading refers to transactions in securities of some company executed by a company insider. An insider might theoretically be anyone who knows material financial information about the company before it becomes public. In practice, the list of company insiders is normally restricted to a moderate-sized list of company officers and other senior executives. Thank you. Revise and get ready for the next